if you keep the stock, what you're saying to yourself is, I am going to think about this stock every day for the next 10 years, say. And that can be a meaningful lifestyle, kind of a meaningful lifestyle impact.
Hi, Meg.
Hello, Scott. Nice to see you again today. Welcome to another episode of Real Personal Finance.
Thank you.
Today, I wanted to talk about this notion of exchange funds because of a conversation I recently had with a client who was invited to join one. And it's a fairly arcane way of dealing with the issue of, oh my gosh, I have so much of my company stock. I have such a huge concentration in it. But if I sell it, I'll have to pay a bunch of taxes.
Right.
So an exchange fund is a way that you can diversify away from just your one company stock and basically have ownership in other stocks also, but not have to pay any taxes in the doing. So that part is very sexy. But my client had said, can you help me figure out if this is actually a good idea for me?
Right.
And in my response to her, I sort of organized my thoughts in a way that I thought might be helpful for other people who listen to this podcast, because you and I work with a lot of clients in tech or in biotech, or just who have executive compensation that results in a lot of a single stock. That is a risk.
Yeah. I think that's great. And we can, we can add to that. There are some other ideas that will float out there often on things you can do to help protect yourself with having a concentrated position. And then we can also just chat about simply selling. So I think that's a good topic for the day.
Yeah. Let's start with the simply selling approach, because you and I both promote that as most often, that's the best thing to do.
Yeah.
Right. And I was telling you earlier about what my favorite, possibly my favorite book for, that I have learned, that I've read in this pursuit of this knowledge, Managing Concentrated Stock Wealth by Tim Kochis. He's sort of the godfather of equity compensation advice. And he wrote this whole book about this very issue of how do you manage a concentrated position in a single stock. And his message in the book, and I watched him speak once, and his message was, usually the best advice is sell it, pay the taxes, and move on.
Yeah. Yeah. That typically is our answer. And it's our answer for a couple of reasons. One is probably helping to fund things that really matter to you now with a known price. And yeah, we do have to pay the government, but you have to pay the government no matter what. It's just a matter of, can we find ways to be a little more tax savings oriented is typically where we go with delaying a sale or using an exchange fund, doing things like that. So it's just simplicity normally trumps complexity.
Yep.
At the end of the day.
And I did see one colleague, there's several months ago, say something like one of the inputs to the keep the stock versus get rid of the stock decision is, if you keep the stock, what you're saying to yourself is, I am going to think about this stock every day for the next 10 years, say. And that can be a meaningful lifestyle, kind of a meaningful lifestyle impact. Whereas if you just sell out of it and diversify into a boring, broadly diversified, low-cost portfolio, you're not thinking about any individual stock performance at that point.
Such an interesting frame, because when you give it to me that way, I liken it to being at a casino, right? And it's like I'm at a casino at a roulette table with chips on one number, Yep. Playing the game, hoping it wins, hope it'll win or lose. And if it wins, we're going to win so big and it's going to be so amazing. But if it loses, oh my gosh, that could be devastating for me. Or I could just ask the casino boss if I could just own a portion of the casino and just make the money that they make by having everyone else come play the game.
Yeah.
Because that's really what indexing does at the end of the day, right? It gives you the average return and it puts the average return in your favor. So to your point, it turns it into like a really boring thing of like, you don't see a casino boss walking around the floor in Vegas excited ever.
Yeah.
Right.
I wouldn't actually know, but I'll take your word for
it. but people are excited and devastated all the time. And that's such a good frame that you just gave for that. I love it.
So you and I talked before this recording about sort of the two ways of just selling it, paying the taxes and moving on. And this is still fairly high level, but you can just sell all of it right now, lump sum, just boom, get it all done on this one day, pay the taxes. This is not like you're not trying to optimize for taxes. You are trying to optimize for simplicity and diversification.
Right.
And then you had sort of characterized the other approach as sort of the dollar cost averaging approach.
Yeah.
But in reverse.
In reverse. It's like people are like, I want to sell, but that earnings call is coming up and I really think it's going to be good. So I'd really like to wait. Another might be, you might be every year moving forward might still have RSU income and stock and salary and bonus. And you're kind of on this projection of income where maybe up to a certain threshold, if you're earlier in your career, but you had some like good options, or RSUs, you may be able to move up your cap gains before you hit the jump from 15 to 20, right? So, and maybe the way you're moving down, maybe you decide, I do want tax strategies do matter to me. So how can I slow it down a little bit? Well, that's a place where you can go, okay, how much do I need to sell each year to get out of this? And over what period of time am I going to do that? But the key is you find a strategy that works for you and you commit to it.
Yeah, commit to it.
And you do it. I think the other thing to add is that for people who have concentrated positions like this, if you're still getting RSU grants and you're still participating in ESPP, like one of the things you can do immediately is start selling the RSUs when they vest immediately, right? Don't keep adding to the problem of getting more concentration. And same thing with ESPP. You can do the same thing and just get a nice little tax break. So I think those are the things I think about in that vein.
Right. So what we generally recommend is sell it either all at once or on some sort of predefined schedule.
Yep.
Sell it, pay the taxes, move on. Okay. Let's say that we and the client decide that for some reason that's not a necessary approach. They're averse to paying the taxes or whatever. Then we get into some more arcane, more complicated solutions to reducing the tax bill, retaining exposure because maybe you feel really good about that Airbnb stock or whatever, and you would kick yourself if you sold it and it continued to go up afterwards. The exchange fund, which I mentioned at the beginning, is one such way of one of those more arcane solutions. But the other one you had mentioned was using options.
Yeah.
And you have way more experience in that than I do. So the floor is yours.
Yeah, well, we've used it in the past. At my old firm, we would use it for some clients who had big concentrated positions, but were wanted protection to the downside. So an option, most people in this space, if they're working in tech and biotech, might have heard of like options for buying stock, right? Like they get stock options.
Yep.
The type of option I'm thinking of here is an option that you actually get to buy or sell on the stock itself that you already hold. So the simplest way to think of it is think of it like an insurance contract, right? Because that's really what it is. So let's say that someone owns $1 million of, or close to a little bit over $1 million of Microsoft stock, right? So if I look at the stock price today and take $1 million and divide it by the price, they own 2,500 shares of Microsoft. So one of the conversations you can have as a client or with yourself or with your advisor is just say, well, hey, the price is currently, it's around $400 right now. And the question is, well, at what point of the price falling would you feel like this is devastating to you? Is it a 20% drop, 10%, 30%? What is that it would have to be? And then what you can do is you can actually go look at the options market and see, well, what does it cost? Because I'm buying insurance to protect myself here, right? And so that's what you're buying when you want to protect the downside of something you own. It's called a put. because if it falls below the price of, if I own it 400 and I want to go buy, let's see, what's 20% down on about 400?
320
is 320, right? So if I want to buy a 320 put right now, it's about $12 a contract. So for, $300, I can get put an option on my stock that if it goes below $320, I can make someone, whoever bought that contract from me, took the other side of it, I can make them take the stock away from me. So, if it falls
$320 per share,
at $320 per share.
Mm-hmm.
So it has to be, you have to look at what price would you want to do that at. And as you can guess, right, the closer we get to on a put, the closer we get to the actual price today, and the amount of time that we have this contract matters too, right? I was looking at about a year out on a contract. But if we want to only go down to $380, well, then I need to pay $28 a contract, right? So I need to pay $700 to protect my downside now. But you can use options to lock in a price. Mm-hmm. You just have to be willing to pay that insurance premium or that called the option price to do so, right? So that's one thing you can do. Another thing that people do, because they don't want to necessarily pay all those options all the time, because you don't just do it one time, right? What happens is you're doing it every 90 days or every 6 months or every year, but then you just keep rolling them forward based on what the price movement's doing and how much downside protection do you want. And people don't necessarily want to pay for that. So another thing that you can do there to cover that is you can create essentially a call strategy, a collar, a put and a call. So you'll buy the put, but you'll sell a call. So you'll say, you know what, if the stock price goes up to, let's see, if it's at 400, if it goes up to 440, 10% higher, I'm happy and I'll sell, right? So you'll just go say like, well, what can I sell options for at 440? And then you'll get that in proceeds, and you'll take some of those proceeds to help offset the put option that you're buying, right? Does that make sense? Yep. So people will do that too. It's something that you can do, but it's complicated and it needs to be monitored. And people will do it thinking like this is easy, but then they won't pay attention to what shares are going to be called away if those shares get called away, and you accidentally call away short-term shares instead of long-term shares, and now you've just created a tax bill for yourself. So it gets really complicated really fast, but it is something that clients can utilize to protect downside if they want.
So you've already mentioned one of the cons, which is simply that it is more complex. And when things are complex, you are more likely to make mistakes. There are more opportunities to make mistakes. Yep. And you can end up, setting up the specific shares that get sold wrong, incurring an unnecessarily big tax bill. Are there any other sort of reasons why you would avoid this particular strategy?
The biggest one's simply the complexity. I mean, I often have clients get lost in the concept of when would you want to, like, they'll think like, well, how much more in stock price do I want to go up or down just to sell alone? Let alone like how much risk are we willing to bear here to elicit a put strategy or a collar strategy, right? It just gets very complicated very quick.
Yeah. And I think you and I are in agreement that there is enough complexity in life that we are almost rabid about trying to minimize complexity in our finances.
Yes. I think the only other thing I would note is I'm scratching the surface on you hold a position and then you go buy puts to cover yourself, and maybe you sell some calls to cover that price. But, and I just want to be very, very clear, please, please, please don't go out and buy call options or put options with no underlying stock. That's just like full on gambling with a volatility and a leverage that is like crazy. And people will make lots of money doing that, or they'll say they make lots of money doing that. You'll see people who talk about making all this money in the options market and the futures market, but it's just full speculation. So I just want to be really clear about what we're talking about here as a strategy to minimize risk, but options can also be used really quickly to create excessive risk.
Yes, that is one of the few things I remember from the CFP exam 14 years ago or something. Was they were discussing options. They were saying, some of the buying or selling of puts or calls your risk is bounded, and some of those combinations, your risk is boundless.
Yes.
So if you buy or sell the wrong kind of thing without owning the underlying share, like there's no limit on how much money you could lose. There's literally no limit.
Extreme example, but people might recall that oil prices went negative when COVID started. And there was sadly a couple of people trying to trade options. And one was a younger guy who sadly took his life.
Yeah.
Because he thought he would put himself in such a dire position. And it was due to the unbounded situation, but also due to an extreme that happened. But yeah, you just don't, it's not worth messing with.
Okay. And so exchange funds sound great because they offer you diversification without having to sell any of your stock and incur that taxable gain.
Right.
Like, great. This is like, the best of everything. Have your cake and eat it too, as it were.
Yep.
Although I recently learned that Marie Antoinette did not actually say that. She said that people could have their brioche and eat it too. Anyway, I know.
Blowing my mind.
And nothing I've just said is wrong. It is just too simplistic a description to fully understand how it would work for you.
Mm-hmm.
And again, going back to what I learned from good old Mr. Coaches, is this offer, this promise of diversification is way less persuasive than it sounds, because these exchange funds are usually formed when a particular industry is doing really, really well. And right now, the last few years, tech has been doing really, really well. So my client, let's say she works at Airbnb. She doesn't work at Airbnb. She was invited by an exchange fund to, hey, do you want to put some of your Airbnb shares into this exchange fund? The message, this sort of tacit message being, because we already have shares from all these other tech companies in there, probably NVIDIA and Meta and Amazon and Microsoft and blah, blah, blah. And so you will go from owning $1 million worth of just Airbnb to $1 million of combined Airbnb and Meta and Facebook, well, whatever, all those tech stocks. Right. So yes, you are getting some diversification. You're diversifying away from the idea that your one company might flail, might falter.
Right.
But you're usually not getting any industry diversification.
Yeah.
Right. So if the tech industry does poorly, you're still poop out of luck. I don't know if we're
yeah. I mean, it's a good question to ask, because to your point, if we go bigger picture for a second, the exchange fund, to your point, what I'm hearing you say is, okay, I have $1 million of Microsoft and it's way too big of a percentage for me, but the basis is so low on this, I really don't want to sell it. Right. And in my head, I want a different solution. So the exchange fund is a potential solution. And at the exchange fund, I'm going to put in my $1 million of Microsoft, and a bunch of other people are going to put in other shares as well from different companies to diversify us, is the idea. When we do that, I stop owning the $1 million of Microsoft technically, and I could technically get my money out faster if I needed to. But what normally happens is there's, to get a special tax treatment to help reduce my capital gains, we need to hold that position for at least 7 years. So I basically am illiquid for 7 years is one way to think of it. So I need to be okay with that.
Yep.
And then while those funds are there, the idea is, to your point, the benefit is I got rid of unsystematic risk, right? I got rid of the risk of just having my money in Microsoft. Now my money's in all of these tech stocks. But I probably, to your point, I probably didn't get broad diversification that I would have gotten had I just sold and gone into a more traditional portfolio.
The promise of diversification, I think, is just oversold. I mean, you can find out what the other stocks are in this exchange fund, so you can judge for yourself whether it's, only mildly diversified or really broadly diversified. But typically, it's not going to be very broadly diversified outside of the sector that your stock is already in. So it's a minor benefit that I think maybe is sometimes pitched as a much bigger benefit. And the other thing that I was reminded of is, again, there are all these tax rules that the exchange fund has to follow in order for you, the participant, to get these tax benefits from it. And one of them is 20% of the money in the fund has to be invested in an illiquid holding, and that is usually real estate. And I'm just going to read a favorite quote from Mr. Tim Coaches about this. He writes, excellent real estate opportunities can be packaged and sold on their own merits. Real estate used to meet a tax requirement for the packaging of some other main event, which is to say, this exchange fund, isn't likely to be the kind of real estate with the very best investment characteristics.
Yeah.
So, it's a very respectful way of describing it. But what he's saying is this is the crap that they can't sell on its own merit. So they're just going to shove it into this fund where you're not likely to really evaluate it on its own merits.
Yeah, they're essentially saying if you're at the butcher counter picking up some meat, you're not getting prime steak ribeyes to fill this this position of illiquidity. You're going to get stuff that's in the back that doesn't even come out to the case.
Yeah, there you go. Yeah. So that was, I thought, because 20% of the fund, that is a large portion.
Yeah, it could definitely affect it.
Yeah. All right. So we talked about illiquidity, which, for some people, illiquidity of the $1 million of Microsoft money that they put in there, maybe it's not a big deal, right? My client's in her mid 30s. She's got, $5 million outside of her stock.
Right.
Sure. She doesn't need this $1 million for, another 7 years. So that is or is not an issue. There is the diversification that usually really isn't much. And then there's this crappy, usually real estate holding in there, which if it ends up being crappy is going to pull down the returns. And you would have been, again, better off selling, paying the taxes, and then investing your money directly in what you believe to be good investments instead of being stuck with this sort of loser.
Agreed. There's also just simply the increased complexity that people often don't think of, but you now have more than likely you're going to have something to the effect of a K1 for your taxes, right? So taxes become more difficult. The extension is going to have to happen versus doing it on your own regular time. So you just have to realize anytime we're doing something that's hey, we can save you money, more than likely there's complexity, and with complexity comes cost and energy to be used. Energy that could otherwise be put to other things in life must now be put to this thing. Right. So you have to be okay with that. Yeah. It's not to say that it's wrong. It's just that typically simpler is better.
I agree with that. And my client had asked me, okay, this doesn't seem like a really good deal. Who is this sort of thing intended for? Who is the exchange fund most likely to work for? And in my opinion, it is people who are in really high tax situations now, especially if in 7 years they expect to be in a lower tax situation. If you live in California now and you're expecting to move to New Hampshire, in 2 years, great, because New Hampshire has no state income tax. Stock that has a really low cost basis. So if all your stock is from RSUs that have vested, most likely this isn't a good deal for you because the taxable gain on your shares is you won't actually owe that much in tax. So why are you trying to avoid it? All right, I'm going to read one more thing for Tim Coaches that actually called out for my client. He said, he was saying, whom would I recommend this to? Or when is this appropriate for clients? And he said, on rare occasions, you may have a client who prefers the exclusivity of an exchange fund. And he says that because it's by invitation only, despite all its limitations.
Yes.
Or one who finds the 7-year lockup helpful for reasons unrelated to investment optimization.
Yeah. So essentially taxes.
Well, he was saying they want what sounds like a valid excuse to not give money to family. Oh, sorry. Can't get access to it. You can't have any.
Too. It's locked up. I can't touch it.
Yeah, would if I could. Can't. Sorry.
What he just said there, though, the exclusive part, it's so funny because to me, that's what you also see with people who want to invest in private equity and in VC funds. And I think because when we go look at the underlying return of those things, which could be a different conversation for a different day, you see that the average VC fund, the average PE fund, once you look at fees, does far worse than just investing in the stock market and calling it a day and not worrying about it. But it's also not sexy and exciting to be at the country club and be like, so let me tell you about my portfolio that's invested in some mutual funds and it's doing really well this year.
Yeah.
You want to say I'm in this exchange fund or I'm in this fund or whatever it is.
Yeah, I feel as if like we need to shift the culture somehow where it's a total flex to be able to describe just how damn boring your investment portfolio is. Like, yes. Oh, really? You spend your time on that? Interesting. No, I spend my time on fulfilling pursuits that, improve my family's happiness or the world or something like that.
Exactly. I actually live life instead of paying attention to what the portfolio is doing. Yeah. Good stuff.
Yeah.
Well, good question for your client. Thanks for bringing that to the table today.
You're welcome.
All right. Well, until next time.
All right. Thanks, Scott. See you then.